First, the $25,000 pattern day trader rule was scrapped. Now, the US derivatives market has just launched its biggest product evolution in 2 decades. The single stock futures are officially back in the United States. CME Group has officially launched cash-settled futures contracts linked directly to individual stocks, including the market giants like NVIDIA, Tesla, Meta, Apple, Microsoft, and even some new kids on the block like SpaceX. Instead of buying 100 shares of NVIDIA stock for $20,000 during standard market hours, or dealing with option Greeks like Theta Decay and implied volatility crush, single stock futures are going to let you trade individual companies 23 hours a day, 5 days a week, just like the index futures, with a joint SEC and CFTC 15% margin requirement. If you've ever wanted to trade an earnings announcement after hours at 5:30 or 6 p.m., or trade individual stock momentum overnight that happens on news without options theta eating your profits alive or not even being able to enter the trade, this is the tool that you've been waiting for. Today, we're covering everything: how security futures work, the joint SEC and CFTC regulation, contract sizing, margin math, and how SSFs compare directly to stocks and options. So what exactly is a single stock futures contract? A single stock future is a standardized contract between two parties to buy or sell a specific number of shares of an individual stock at an agreed upon price on a specified future date. A lot of the same language we use for index futures or commodity futures. But unlike the traditional commodity futures like crude oil or the index futures like the E-mini S&P or the NQ NASDAQ, the underlying asset is one single corporation's stock. So the CME Group introduced 2 specific contract sizes for the US retail and institutional market. Standard SSF contracts are sized at 100 shares of the underlying stock, so 100 times the stock price. Sounds a lot like options if you're familiar with that. And these are ideal for an institution who wants to hedge or a large account that needs some position management. And there's also the micro SSF contracts, and those are sized at 10 shares of the underlying stock. So that's going to be 10 times the stock price. And those are designed specifically for really retail traders who are trying to do these quick little movements, who want that precision for those quick intraday scalp moves, and also for small accounts so that small accounts can have some more reasonable sizing for a better entry level. As for settlement, both contract sizes are financially cash settled in US dollars, meaning there's never any physical stock delivery headaches. You might have heard dramatic stories about crude oil barrels having to be delivered. It's not like that. They're all cash settled, which is the European style delivery. And the expirations run on a standard quarterly cycle in March, June, September, and December, like the futures market, not like the options market. Those have quarterlies too, but you know what I mean. So let's look at an example. So if NVIDIA is trading at $200 per share, a standard NVIDIA SSF controls 100 shares representing $20,000 in notional value. The initial margin at 15% is $3,000. A micro NVIDIA SSF controls 10 shares, so that's going to represent $2,000 in notional value. With your 15% margin, that means that you're going to need $300. And because these contracts are cash settled, when the contract expires on the third Friday of the contract month, your account is credited or debited the cash difference based on the official closing price of the stock. If you're still in it, but let's think about it. Most of us are just in these for a good time, not for a long time. We're going to be trading these intraday or scalping them, not expiring with them. If you're a market history buff, you might be thinking, wait, didn't we have single stock futures before? Yes. So in 2002, after Congress passed the Commodity Futures Modernization Act of 2000, an exchange called OneChicago launched single stock futures in the US. By 2020, OneChicago quietly shut down because there was low volume, so nobody was using them. But back in 2002, we had crazy high 20% margin requirements, zero retail broker distribution, so no access to retail traders, and literally dial-up infrastructure. So there was physical stock settlement headaches. It wasn't cash settled. And there were no micro-sized contracts. So a pretty large barrier of entry compared to what we have now. So today's revival changes everything. There's a reduced 15% margin floor, and now we have 23-hour electronic order routing and trading, and we have integration into over 35 of the top retail brokers like Thinkorswim, Interactive Brokers, and Webull, and Robinhood. And the micro 10-share contracts make it really is going to feed that massive retail demand for 23/5 trading of all of these popular companies. And it's going to really lower that barrier of entry. And because single stock futures involve both individual stocks, which is the SEC, and futures contracts, which is the CFTC, they're classified under the US law as securities futures products, and they end up being regulated by both the SEC and the CFTC. So here's that paper trail. In April, the CME Group registered as a national securities exchange for securities futures. In June, the CME proposed amendments to Rule 930, which is setting the customer margin requirements for these products. Then in July, the SEC formally approved the CME's rule changes that were proposed earlier in June, and that set the official customer margin floor at 15% of the market value, the notional value that we were just talking about. And the formula for that margin is pretty simple. So you are just taking the contract market value and multiplying that by 15%. And that'll give you the margin requirement, which is about 6.67 times leverage. All right, let's compare the single stock futures directly against trading stocks, options, and index futures across all of these kind of main things that we need to know about. So compared to buying stocks, the single stock futures give you 23-hour trading 5 days a week with the 6.67 times leverage versus the 2 times leverage that you get with stocks potentially. All right, how about compared to shorting and trading options? And I'm grouping those together because they have really similar rules. And I will point out that you can short the market by either buying option puts or selling call options. And there's a lot of different things that you can do to either collect premium or just see if you can buy it low, sell it high. When you get into all of this non-linear option Greeks and margin collateral and then you end up with assignment risks and it gets really complicated. And the nice thing about the single stock futures is they let you just go long or short real quick with just linear up, down, buy, sell, one-to-one stock tracking. And you don't have to worry about theta time decay and implied volatility crush and the things you have to worry about with the options market. And then if you want to compare it to trading the index futures like the NASDAQ and the S&P, NQ, and ES and their derivatives, the index futures really force you to trade the entire market basket all at once. And the single stock futures let you target these single stock catalysts like NVIDIA earnings or if Tesla is launching a product directly. And the NASDAQ will feel that, but not as directly as, some of these wild moves that you might want to catch directly. So let me show you kind of a real world example of what I'm talking about here. So imagine that NVIDIA is heading into its earnings announcement at 4:15 p.m. post-market, trading at $100 a share. It hasn't in a while, but we can imagine for the sake of easy math. So you decide to trade 5 micro NVIDIA SSF contracts. So 50 shares total is what you're controlling. The notional value is $100, the price of the stock, times 50 shares. So $5,000. And then if you do the required initial margin math off of that, that's $5,000 times 15%, so times 0.15. And then we come up with a required margin of $750. So you only need $750 in account margin to control a $5,000 position in NVIDIA. So let's say at 4:30 p.m., NVIDIA releases some just amazing stellar to the moon earnings, and the price surges from $100 to $110 in post-market trading just real quick. So your profit of $10 per share times 50 shares means that you've just made $500 in profit on a $750 margin deposit. That's a 66.6% return on invested collateral in under 30 minutes. It's pretty good. And because the futures trade continuously, you can lock in your profit at 4:32 p.m. right in the middle of the conference call when things start to change without waiting for the market to open up at 9:30 a.m. the next morning. So how does your broker handle single stock futures? Because SSFs are security futures products, how they show up in your account depends on your broker's registration. So multi-asset brokers like Charles Schwab with Thinkorswim, Interactive Brokers, or Webull, they're going to hold the full broker dealer license and they'll be able to support the security futures routing natively. It's already going to be there. When it comes to the pure futures brokers, that'll be Tradevate, Ninja, AMP, that kind of group. They operate as FCMs and they require notice regulation with the SEC in order to route securities futures. And there's another major catch for futures day traders because there's no $50 day trade margin discounts on the single stock futures like we get with the index futures. And that's because the SEC and CFTC rules enforce that 15% customer margin floor, so you can't bypass that you can't bypass that minimum at any of these brokers, even if they're a discount broker. So a $2,000 micro Tesla contract will always require $300 in margin, whether you trade at Schwab or Interactive Brokers or Tradevate. Quick outfit change, because since writing and recording this, the single stock futures have officially started trading. And it turns out that there's a big problem, a liquidity problem. On paper, the specs are an absolute dream, but when the opening bell rang and day traders actually pulled up the level 2 order books, what did we see? a ghost town. If you go check the charts right now on the mega caps like NVIDIA or Tesla, you aren't seeing penny-wide spreads like we get on cash shares or the high volume at the money options. So instead, what we're seeing is some bid-ask spreads that are 10, 20, or even 35 cents wide, which if you're used to futures is not going to be something that you know how to deal with right away. And for the depth of market, there are literally 1 to 5 contracts sitting at the top of the book. So that means that the total daily volume across single stock futures is less than 1/100% of the underlying daily volume. So options are still eating 99.9% of the derivatives flow. So what is making this a big red flag for futures day traders who would be potentially trading these things? 2 concepts here: slippage and spread drag. So let's do the math on a standard Tesla contract. At a 15% margin requirement trading around $200, you have to put up $3,000 in collateral in order to control that position. And if the futures spread is 25 cents wide, crossing the bid-ask spread to get in and out costs you $50 just in that little transaction. And that's nearly 2% of your entire margin collateral that's wiped out before the stock even moves, which is pretty expensive. So even worse, if a stock suddenly flushes on news, a 10 contract market will walk right through the thin little order book, blowing through, 3 or 4 price levels, maybe more, before, it's going to give you some really bad slippage, is what I'm saying. So if you use a passive limit order and the price drops right past you, nobody fills you, and you get stranded in this runaway position. And this has happened to me trading NDX options. So it's painful, trust me. So if you're asking, why doesn't someone just tighten the spread? Well, welcome to the classic market maker chicken and egg paradox. And this is the exact reason that OneChicago died back in 2020. On one side, the market makers won't post the tight penny-wide bids and asks without active two-way retail order flow. And hedging a single stock future requires holding cash stock and paying borrowing fees. So without steady volume to offset all of this inventory, they have to widen their quotes defensively to protect against this adverse selection. And then on the other side, the active day traders and algorithms just don't want to touch an order book that has 25-cent spreads and 2 contract depth. It doesn't make any sense. So right now we're in a complete standoff. And back in 2020, when retail brokers slashed cash stock commissions to basically zero, OneChicago's remaining volume just evaporated overnight because nobody wanted to pay more futures spread drag when they could just trade the cash shares for free. So what actually needs to happen for single stock futures to become a massive success this time around is basically 3 things. We need aggressive exchange subsidies, where CME and liquidity providers need heavy rebate programs to, kind of artificially subsidize 1 to 2 cent spreads with natural volume builds. And we can also have a frictionless broker UI integration. So platforms like Webull, Schwab's Thinkorswim, and Robinhood would need to put single stock futures front and center on the primary equity watch list so that retail traders can click and trade with one little tap, and it's not buried in obscure futures permission menus like a lot of these more complicated products. And then the institutional swap mitigation and 60/40 tax clarification. Really, everyone, in order to feel comfortable, we need some explicit IRS Section 1256 blend tax treatment so that the high bracket active traders get a massive reason to ditch cash equities and get that same tax treatment that you can get with some of these index derivatives. And so until the futures pieces kind of fall into place, we really need to be smart and treat the SSFs with some tactical discipline. And so that's things like don't use market orders, just only use limit orders, and keep your size conservative and really pay attention to what's happening on the order book in the depth of market. All right. Let me address the risk warnings because futures leverage cuts both ways. So a 15% margin requirement means a 15% adverse move in the underlying stock that moves against you can wipe out 100% of your margin requirement if you don't use stop losses. All right. And there could also be some thin liquidity overnight because we get the bid-ask spreads can get really wide during those thin overnight hours when people are sleeping in the United States, like 2 a.m. Eastern. So you really need to pay attention and make sure it's a liquid product that you're able to get in and out of at a reasonable spread. And always use limit orders, never market orders when you're outside of those core session hours to make sure that you don't get affected by that crazy slippage. All right, the dynamic circuit breakers still apply to these. So the CME applies dynamic price limits to prevent flash crashes in single stock contracts when the underlying stocks are halted on primary exchanges. So that works the same as those halts that you might be familiar with NASDAQ and ES that we were a little bit worried about during the Trump tariff stuff. And you do have to worry about those halts and things happening with the single stock futures as well. Okay, I feel better. So to sum it all up, you can get 23/5 continuous trading, so you're never trapped overnight if you want to play any of these special moves. You have a 15% margin floor for 6.67 times leverage with 0 theta decay and 0 short borrow fees. So that's a little bit different than when you're shorting options and stocks and things. So you have flexible micro 10 share sizing that helps you really scale in and scale out with small accounts and even be able to have access with small accounts. And strict risk discipline with stop losses should always be turned on because you need to be paying attention to the margin and what you're actually using. And by the way, I have more videos like this one already posted and more on the way. And if you want to hang out in our free community, we have a free Discord and maybe you can win some of our ranch giveaways. Head on over to thetradingranch.com for all of that info. Or if you just want the fast track links with all of the broker and prop discounts, you can go look at my link tree at BULLBARBIE.link. And now I'm curious, so do me a favor if you like this video or if you didn't, comment and let me know which stock are you most excited about trading via single stock futures, or what are you most worried about? All right, manage your risk, use stop losses, and I'll see you next time. Love you.